Good morning and welcome to Global Markets Daily Brief. I'm Jonathan Simkowitz, and today is Thursday, February the 19th, 2026. And the question the market is really trying to answer today is not whether we go to war with Iran, but how you price a 10-day countdown to a binary outcome that could reshape global energy flows overnight. Let's start with the biggest story of the day. President Trump told his inaugural Board of Peace meeting in Washington that the United States will decide within the next 10 days whether to strike Iran militarily or pursue a nuclear deal. And the Pentagon has confirmed the military is prepared to act as early as this weekend, with 2 carrier strike groups, the USS Abraham Lincoln already in the region, and the USS Gerald Ford now en route, representing the largest American military buildup in the Middle East since the 2003 invasion of Iraq. The market's first reaction was immediate and directional. WTI crude jumped over 2% to around $66.68 per barrel. Brent pushed above $71, and defense-adjacent names caught a bid, while the broader equity indices pulled back roughly 1/4 to 0.5% across the board. That is the textbook geopolitical risk premium trade, and on the surface it makes perfect sense. But here's what most people are missing. The market is pricing this as a tail risk event with a moderate probability, when the reality is that we now have a specific timeline from the president himself, a massive force deployment that mirrors historical pre-strike pattern, and a diplomatic channel that both sides describe as making only marginal progress. The gap between how the options market is pricing this and the actual stated intent from the White House feels too wide to me. What's priced in is a modest oil risk premium and some defensive rotation. What is not priced in is a sustained multi-week military campaign which US and Israeli officials have told Axios is the likely shape of any operation, nor is the market pricing the second-order effects on the Strait of Hormuz, which handles roughly 20% of global oil transit. If this escalates, oil doesn't go to 70, it goes to 90 or higher, and that reprices inflation expectations, the Fed's rate path, and every single equity multiple in the market simultaneously. The trade-off is stark. If diplomacy prevails within the 10-day window, crude gives back its gains quickly and equities rally on the relief. But if strikes begin, especially during Ramadan, which started yesterday, the geopolitical risk premium becomes structural, and we are looking at a fundamentally different macro environment for at least the next quarter. My base case, and I hold this loosely, is that the buildup is genuine leverage designed to extract concessions from Tehran, but the margin for miscalculation is extremely thin, and I would not want to be short volatility heading into the recount. With watch, frasting in the torch of US partiality moved over the region, which the Pentagon is already done, doing as a precaution that we measure, and second, whether Iran should make a written proposal on its nuclear program the 4-month out, or US officials have anticipated as the practical deadline. Alex time to Klarna, which is having its Wednesday as a public company, signs a damn Rofi 24 to Santos of this afternoon after the buy multi Laker company aborted a 4-year pretax of $241 million, despite tooling in record revenue, with non-loss to visit rising 59% year-over-year. The company's Q1 guidance, the growth revenue and gross merchandise volume pen and other RMS estimates, which is Rob Shuri Brechter stock. The market's reaction tells you exactly when sentiment cost. Investors had priced time for a smooth that account to credibility fallen in his IPO less than 6 months ago, and instead bigger took consecutive quarters of losses. The visits the sovereign loans that now represent 0.72% of Glasnost does, growing month from 0.44% a year ended, and the CEO won't Spain to miss by pointing the fast amending grant than the mid-fair financing target that is a managed 19 choosy market share in the market, and the market is promising for it. What most people are missing here is that this is not just a Klarna story. It is a leading indicator for the entire buy now, pay later and consumer credit space, because if Klarna, the category leader, is seeing loan losses accelerate at this pace, it raises serious questions about credit quality across the consumer fintech sector broadly. And there is a class action lawsuit with a lead plaintiff deadline literally tomorrow, February the 20th. What's priced in now is disappointment. What may not be priced in is contagion to peers like a firm and block, or the possibility that regulators use this as ammunition to tighten oversight of the BNPL space. Looking at the broader market snapshot, the S&P 500 is down around 0.2% to roughly 68. The Dow is off about 0.3 to around 49,500, and the Nasdaq is slipping about 0.2 to roughly 22,700. This after a 3-day winning streak that had helped markets recover from the AI disruption sell-off. Walmart beat on Q4 revenue and raised its dividend, but the stock's initial pop is fading as full-year guidance disappointed. Deere jumped around 7% on earnings that support the narrative that we're near a cyclical trough in agriculture equipment, and the VIX has ticked up about 5%. So psychologically, the market is telling you it is cautiously positioned, not panicking, but hedging against a weekend that could bring military action in the Middle East. Our third story is one that doesn't fit neatly into a financial framework, but the market implications are real and underappreciated. Andrew Mountbatten Windsor, formerly Prince Andrew, the younger brother of King Charles III, was arrested this morning on suspicion of misconduct in public office, following revelations in the Epstein files that he allegedly forwarded confidential British trade reports to the convicted sex offender Jeffrey Epstein while serving as the UK's international trade envoy. This is the first arrest of a senior member of the British royal family in centuries, and King Charles responded by saying the law must take its course. The direct market impact is limited in the traditional sense. This is not moving the S&P 500, but the second-order effects matter for anyone thinking about UK institutional risk and the broader Epstein disclosure cycle. The arrest signals that the British legal system is willing to pursue cases against the highest-profile figures connected to the Epstein files, which the US Department of Justice released in late January, and that creates a tail risk for any publicly traded company, financial institution, or political figure whose name surfaces in those documents. What's not priced in is the possibility that this sets a legal precedent that accelerates further investigations and arrests. If you are a portfolio monitor with expatriate UK equities with Sui Bryant's tie to the monarchy or financial institutions named elsewhere in the Epstein files, this is a risk factor that goes on line item in your salario marriages. Even if you talk mud like precisely, the plan does not move meaningfully on the news today. The occupational contate and dunes the wiper a same fuse. Every crass our section yields are backed up the day after yesterday's minutes revealed that several officials suggest to be central bank and they need to raise rates of inflation to assist the death target, which is a hopey signal that passes with the market expectation of 2 to flake cuts this year. The 10-year is trading around 4.09 to 14%, reversing its recent sign to a few-month lures in a combination of rising oil crages and sticky inflation expectations is exactly the microcy that gives the federal hold longer than anyone wants. Gold is roughly around $5,000 per ounce, which is notable because you'd normally expect the geopolitical soak to pull higher, and the fact that it doesn't suggest the treasury yield backup is acting as a counterweight. The dollar is firming, which grips further pressure on commodities and emerging market assets, and oil is the clear outlier, up sharply on the Iran risk premium, and now threatening to undo the disinflationary narrative that had been building since last week's softer CPI print. If I'm wrong about the base case, if strikes do happen this weekend and the conflict extends into a sustained campaign, it will look like oil gapping above $75 on WTI, the 10-year yield reversing sharply lower on a true flight to safety bid as equities sell off, gold breaking above 5,200, and the VIX spiking into the low 30s, all within 48 to 72 hours. So let me bring it all together. Today is a day defined by a countdown, a credit crack, and a royal arrest, and the common thread across all three stories is that the market is underpricing tail risk in each case. My base case is that the Iran dueled is coercive diplomacy that ultimately produces a deal framework. Klarna's pain is company specific, but foreshadows broader consumer credit stress, and the Mountbatten Windsor arrest is a slow-burning institutional risk for UK markets that most investors will ignore until they can't. The bull case is that Iran submits a credible proposal within days. Oil gives back its gains. The Fed minutes are dismissed as stale, and equities resume their recovery rally into Nvidia earnings next week. The bear case is that strikes begin over the weekend. Oil spikes, the Fed is boxed in by rising energy prices, and the consumer credit cycle turns in a way that makes Klarna look like the canary in the coal mine. This is market commentary, not financial advice. Always do your own research and consult a qualified professional before making investment decisions. If this analysis helped you think about what's ahead, please subscribe to Global Markets Daily Brief wherever you listen. Leave a review, and I'll see you right back here tomorrow morning.